An 82% yield. Sounds incredible, right? One of the most popular weekly dividend ETFs in 2026 advertises an 82% distribution rate, and since it launched, the average investor in that fund has lost money. Not made money, lost it. That's not a typo, and that fund is not alone. Today, I'm going to show you why most of the 130 plus weekly dividend ETFs on the market right now are not what they seem, and more importantly, which 8 actually passed a 3-filter test I built to separate real winners from expensive traps. One of those filters is so simple it takes 10 seconds to check, but almost nobody does it. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, if you're in your 20s or 30s and you've been seeing these weekly ETFs pop up everywhere, 40% yields, 80% yields, weekly deposits hitting your account, I get the appeal. It looks like a shortcut to passive income. But here's the thing. When you're early in the game and every dollar matters for compounding, the last thing you can afford is a fund that quietly gives you back your own money and calls it income. A few years ago, there were about 5 weekly paying ETFs. 5. Today, there are over 130. YieldMax alone has around 58. Roundhill has 31. Granite Shares has 33, and they keep launching new ones. But here's what's happening on the other side. Funds are getting shut down. In June 2026, YieldMax closed 4 ETFs, their Airbnb fund, their Disney fund, and 2 others. Rex shares dropped about 7 weekly pairs. Granite Shares had to do reverse stock splits on multiple funds because share prices had eroded so badly. So before we go any further, do you own any weekly dividend ETFs right now? Yes or no? Drop it in the comments. I'm curious how many of you are already in this space. Now, I said most of these are traps, but I haven't told you why yet, and it comes down to one number that almost every YouTube video about weekly ETFs gets completely wrong. The biggest lie in weekly paying ETFs. Here's the myth. A fund with a 40 or 80% distribution rate means you're earning 40 or 80% on your money every year. Here's the truth. Distribution rate and total return are 2 completely different numbers, and the gap between them, that's where most people lose money without realizing it. Let me show you 3 real examples. First, MRNY. That's YieldMax's Moderna fund. It has an 82% distribution rate. Sounds amazing, but since it launched in October 2023, the average annual return for investors is negative. Negative. You got your weekly deposits, but your shares lost more value than those deposits were worth. Net result, you have less money than you started with. Second, CHYP, YieldMax's semiconductor portfolio fund. It has a 40% distribution rate. But here's the number nobody talks about. Its 30-day SEC yield, that's the measure of actual net investment income, is 0.00%. Zero. That 40% headline, nearly all of it is option premium and return of capital, not real earnings. Third, USOY, Defiance's oil ETF. Its most recent distribution was 93.5% return of capital. For every dollar you received, 93 cents was your own money being handed back to you. That's not income, that's your principal in a costume. Now, return of capital, ROC for short, is when a fund pays you from your investment instead of from earnings. It's not taxed right away, which sounds like a win, but it reduces your cost basis. So when you eventually sell, you owe more in capital gains. The tax isn't gone, it's just waiting for you. So let me think through this. Say you put $10,000 into a fund with an 80% distribution rate. Over a year, you get $8,000 in deposits. Feels amazing, right? But if your shares are now worth $4,000, you didn't earn $8,000. You started with $10,000 and now you have $12,000 total. That's a 20% return, not 80. And honestly, a lot of these funds don't even manage 20. Here's a question for you. A fund pays 82% a year in distributions, but your shares are worth less than when you bought in. Did you make money or lose money? Think about it. So now you know the trick. The yield number is marketing, but that raises the real question. How do you actually tell which weekly ETFs are growing your wealth and which ones are eating it?
I built a 3-part filter, and it takes about 30 seconds per fund. 3 filters for picking weekly dividend ETFs. Here are the 3 filters. Simple, Repeatable, you can run them on any weekly ETF in about half a minute. Filter 1. Total return has to beat the distribution rate. Pull up any free site, Stock Analysis, Yahoo Finance, Morningstar. Find the fund's year-to-date total return. That includes price change plus all distributions reinvested. Now compare it to the advertised distribution rate. If the total return is lower, the fund is paying you from a shrinking base. Your weekly deposits are coming out of your own investment. That fund is not growing your money. Move on. Filter 2. Assets under management above $50 million. Every fund that got shut down in 2026 had low assets. ABNY, DISO, FEAT, FIVY, all small. When a fund doesn't attract enough investor money, the issuer pulls the plug. And when they close a fund, you get liquidated at whatever the current price is. If you're down, that loss is locked in. So check the AUM before you buy. Takes 5 seconds. Under 50 million, it's on the chopping block. Filter 3. The underlying has to be in a real uptrend. These weekly ETFs don't create returns from nothing. They're wrappers. They sell options on a stock or a sector index. If that stock isn't climbing, the premium dries up, distributions fall, and NAV erodes. So ask yourself one question. Would I own this stock on its own? If the answer is no, the weekly ETF version is not going to save you. And honestly, when I ran all 130+ weekly dividend ETFs through these 3 filters, I expected maybe 15 or 20 to pass. It wasn't even close. The number that cleared all 3? About 8. That's it. 8 out of 130+. Quick question before we move on. Which of these 3 filters do you think matters most? Total return, fund size, or the underlying stock? Drop it in the comments. I read every single one. All right, you've got the filter. Now let me show you the 8 that actually passed, and I'll be straight with you. Which ones are strong, which ones barely made it, and which one might surprise you. The 8 best performing weekly ETFs of 2026. Let's start with the biggest winners, and they all have one thing in common: semiconductors. AMD is up about 160% this year. ARM Holdings is up about 144%. AI demand, data center deals, government contracts, the chip sector has been on fire, and the weekly ETFs built on those stocks rode that wave. First, AMDW, Roundhill's AMD Weekly Pay Fund. This one gives you 1.2 times AMD's weekly return through total return swaps, plus a weekly distribution. Year-to-date total return is roughly 175 to 186%, depending on when you pull the data. AUM about $122 million. Expense ratio 0.99%. No options cap, full upside, full downside, times 1.2. Next, AMDY, YieldMax's AMD Option Income Fund. Total return about 104% year-to-date. AUM around $420 million. Distribution rate roughly 57%. Now here's the key difference. AMDY sells covered calls on AMD. That caps your upside. In a year where AMD went up 160%, that cap cost investors roughly 70 points of return compared to AMDW. That's a real trade-off, and it matters. Third, ARMW, Roundhill's ARM Weekly Pay Fund. Total return this year is somewhere between 161 and 286%, depending on the exact date. ARM has been wildly volatile, swinging from a high of about $428 down to $271 in a matter of weeks. But here's the catch. The AUM is only about $15 to $30 million. That fails filter 2. And I know this is going to bother some of you because ARMW is the second best performer on every other list. But if the fund gets liquidated because there's not enough money in it, your return history doesn't matter. I'd rather own a slightly slower winner that's still going to exist next year. Fourth, CHPY, YieldMax's semiconductor portfolio. Distribution rate about 40%. AUM roughly $395 to $428 million. But that 30-day SEC yield of 0.00% means the income is almost entirely option premium and return of capital. It passed the filter on total return in AUM, but just barely, and it's trailed the SOXX semiconductor benchmark by about 20 points since launch. Now, the sector plays. OSY, Defiance's oil ETF. About 52% total return year to date. Sounds solid. But oil spiked this year because of geopolitical supply disruptions in the Strait of Hormuz and the Red Sea. The EIA's July forecast has oil pulling back to the mid-60s later in 2026. And remember, 93.5% of the last distribution was return of capital. This is a trade, not a buy and hold.
MRNY, YieldMax's Moderna fund, trailing one-year return roughly 83%. Moderna stock bounced about 125% on an FDA flu vaccine approval and pipeline catalysts. But, and this matters, the average annual return since MRNY launched is negative. This fund caught a wave, it didn't build one. CRSH, YieldMax's short Tesla fund. Tesla is down about 30% this year after a rough second quarter earnings report, where operating income came in way below expectations. CRSH profits when Tesla falls. Distribution rate about 49%, expense ratio 0.99%. But this is a conviction play. If Tesla rebounds, CRSH takes the full hit. And finally, SEMY, Granite Shares Yield Boost Semiconductor. It sells put options on 3 times leveraged semiconductor ETFs. Distribution rate about 39%, expense ratio 1.07%. But it launched in November 2025, 8 months old, very limited track record. Granite Shares did announce they're lowering distribution targets and working on NAV stability across the suite. That's a positive change, but it's unproven. So those are the 8, but here's what most videos won't tell you. Even the winners have a shelf life, and there are 4 specific signals that tell you exactly when to get out. When smart investors exit weekly ETFs. These 8 funds won because specific stocks ripped in 2026. AMD up 160%, ARM up 144%, Moderna bouncing on FTA news, Tesla falling after earnings. When those stories change, and they will change, these funds fall, and they fall harder than they rose. 4 signals tell you when it's time to step away. Signal 1. The underlying momentum breaks. If AMD or ARM rolls over, the funds built on them follow, and they follow at 1.2 times or worse. Watch the stock. If it breaks below its 50-day moving average, that's your early warning. Signal 2. A reverse split announcement. YieldMax did a reverse split on 15 funds. Granite Shares split 3 of their funds at ratios like 1-for-6 and 1-for-8 in June 2026. A reverse split means the share price has eroded so far that the issuer has to reset it just to keep it tradable. That's not a routine adjustment. That's a red flag. Signal 3. AUM sliding toward 20 million. If money is flowing out, institutional investors are heading for the door, and retail investors, that's most of us, are usually the last to find out. Check AUM once a month. Takes 10 seconds. Signal 4. Rising return of capital percentage. Every issuer publishes something called a 19A1 notice. It breaks down exactly how much of each distribution came from real income versus return of capital. If the ROC percentage keeps climbing, the fund is recycling your own money back to you at a faster rate. That's a slow bleed. Now, one more thing, and this is especially important if you're in your 20s or 30s. If you hold any of these in a regular taxable brokerage account, option premium from single stock ETFs is taxed as ordinary income. That means your highest bracket, not the lower capital gains rate most people expect. If you're going to own weekly ETFs at all, hold them in a Roth IRA or a traditional IRA. Keep the tax drag away from your compounding years. That move alone could save you thousands over time. And here's the line I want you to take away from this entire video. Distribution rate is the bait. Total return is the truth. Smart investors building wealth in their 20s and 30s know the difference. So let me ask you straight. After seeing all of this, are weekly ETFs worth the risk, or are you sticking with monthly payers? I want to know. If you know someone who just bought a weekly ETF because they saw an 80% yield, share this video with them right now. Seriously, it could save them real money. And do me a favor, drop the ticker of any weekly ETF you currently own in the comments. I'll tell you whether it passes the 3-filter test. If you are building income from your investments and you want breakdowns like this, no hype, just the truth about what actually works, subscribe to this channel and turn on notifications so you don't miss the next one.